Exchange rates are influenced by a wide range of economic, financial, and policy-related factors. Fundamental determinants include inflation rates, interest rates, economic growth, trade balances, fiscal conditions, and capital flows. Changes in these variables affect the demand and supply of currencies, leading to appreciation or depreciation. Purchasing power parity suggests that countries with higher inflation tend to experience currency depreciation over time, while interest rate differentials influence investor capital allocation decisions. Analysts use various theoretical frameworks to evaluate currency values, recognizing that exchange rates often reflect both current economic conditions and expectations regarding future developments. Several models help explain long-term and short-term currency movements. The flow mechanism focuses on current account balances, suggesting that persistent trade deficits can place downward pressure on a currency because domestic residents demand foreign currencies to pay for imports. The portfolio composition approach considers how accumulated foreign asset holdings influence investor portfolio decisions and currency demand. Monetary approaches emphasize the role of money supply growth, inflation expectations, and relative economic conditions. These frameworks provide valuable perspectives on exchange rate determination and help analysts evaluate whether currencies are overvalued, undervalued, or likely to experience future adjustments toward equilibrium levels. Carry trade strategies are among the most widely used currency investment approaches. A carry trade involves borrowing funds in a low interest rate currency and investing in a higher interest rate currency to earn the interest rate differential. Under normal market conditions, carry trades can generate attractive returns. However, they expose investors to significant exchange rate risk. If the higher-yielding currency depreciates substantially, exchange rate losses may outweigh interest gains. Carry trade returns are also characterized by negative skewness and excess kurtosis, meaning that investors may earn small gains consistently but face occasional large losses during periods of market stress, volatility, or sudden shifts in investor sentiment. Central banks exert a powerful influence on exchange rates through monetary policy, interest rate decisions, foreign exchange interventions, and communication strategies. Higher policy interest rates generally attract foreign capital and support currency appreciation, while lower rates may encourage depreciation. Central banks may also directly intervene in currency markets by buying or selling foreign reserves to influence exchange rate movements. Market participants closely monitor central bank statements because expectations regarding future policy often affect exchange rates even before actual policy changes occur. Consequently, understanding central bank objectives and policy frameworks is essential for forecasting currency behavior and evaluating international investment opportunities. The interaction between exchange rate determinants, carry trade dynamics, and central bank actions creates a complex environment for currency analysis. Frameworks such as purchasing power parity, uncovered interest rate parity, the monetary approach, and the Mundell-Fleming model provide analytical tools for understanding currency valuation and market behavior. However, exchange rates are influenced not only by economic fundamentals but also by investor expectations, risk perceptions, and policy credibility. For CFA candidates, mastering these concepts is important because currencies affect global asset allocation, portfolio performance, risk management, and international investment decisions. Effective currency analysis requires integrating macroeconomic theory, market dynamics, and central bank policy considerations.